All right. Hello, everybody. Today I want to start getting into the chapter 7 topics. Uh, Before you really get into this video, you should make sure that you go over the playlist of videos for chapter 7 because they give you the foundation of what you need to really dive deeper into the problems. I'm going to be looking at three problems from the chapter 7 problems. We're going to look at a bank wreck. We're going to look at um, cas- classifying cash and cash equivalents and what that means. And we're also going to look at an account receivable problem, go over some basic accounts receivable transactions, and really focus on the adjusting entry for bad debt expense. So these are sort of chapter 7 has really that's the only thing that's going to be on exam two, but it has a few parts to it. So there's the cash part, there's the receivable part with accounts receivable, and then there's a tiny part with notes receivable as well. And so we're going to kind of do the first half of it today, the second half of it tomorrow. But again, make sure you're going through these chapter study problems. Make sure that you're working through these things. I have some videos up of other chapter study problems I've worked through in the past and uploaded for my courses. Those are available as well. So let's go ahead and get started with that. I'm going to switch over to my document camera. And as I mentioned in the announcement, the very first thing I want to work on is this. This is from example number one. It's problem number three in that group of problems. And it is about a bank reconciliation. So just some quick, kind of to visualize, and I'm a very visual person. So to visualize what's going on with the bank rec, what we're doing here is bank recs are done at the end of a period. Typically, at end of the month is kind of a nice stopping point for a bank rec. And what you're trying to do is verify two separate sources of information, right? You have the information that is on the company side. And so I usually call that like the books. So this is the company side information. And, the problems and my lectures kind of call this like the book balance or the cash account balance. So this is what we're looking at from our perspective as a company. And then you got another source of information, which is the bank side. And this is our bank account. And we might have multiple bank accounts. You would have to balance each of them. And usually I just call this the bank balance. And what, because they're two different parties, obviously, banks and books. um, they're going to have different things within each of their information sets. They're going to have some extra information. For example, the company's going to know things that the bank might not have recorded yet, and the bank will know things that the company hasn't recorded yet. And part of the reconciliation is bringing those two things together to agree. So, what we're going to do then is take these balances, and these balances, as I said, our bank recs tend to happen at the end of the month. But we're going to take these two separate sources of information and then apply items that, for example, the company has a lot of knowledge about the checks it's written and the deposits it's made, but it doesn't have certain information that it needs from the bank. For example, it doesn't know how much interest might have accrued in the bank account that they have. And we would need to add that to the end balance. This is the end of period for both the bank and the books. We need to add that in to this book balance because it's not there yet. It's something that the company doesn't know until it verifies from its bank account how much interest they've earned, right? We don't need to add in things that the company should already know, right? So if we wrote a check, if this is the end of June, if we wrote a check during June, the company should have that information already in its balance. Um, so we don't need to worry about deposits we made during June or checks we wrote during June because that's stuff the company should already have in its balance, right? If it doesn't, that's an error. And yeah, okay, we do need to adjust for that. But we assume that it has all that information in there unless we know otherwise. So interest revenue is one. Um, One that is another one that the company will not know until it talks with the bank or looks at its accounts is any NSF checks deposited by company. And so that means an insufficient funds check that was written to us, written to our company, but the person who wrote it doesn't have the funds in their bank account to cover it. And so that's a type of information that the company does not know about until we deposit the check that we think is good into our bank. The bank contacts the bank of the person who wrote the check, tries to draw on that check writer's balance and can't. Well, then our bank will tell us, hey, this check you deposited written to the company is we can't honor it. There's no money in that person's account. And so that's an NSF check that we have to deal with. And the final one is any service fees. These are the three common ones that we see a lot. Service fees charged by the bank. And of course, we would subtract those from our cash balance. So, how we deal with each of these, we'll talk about as we're doing the journal entries. But these are the three pieces that company records don't have typically until the end of the period. And then if there is an error in our book balance, like if we wrote a check and we recorded the wrong amount when we wrote our check, maybe we're paying off our utility bill, and we record the wrong amount in our ledger, in our book balance for cash, then only when we see that, oh, the bank cleared it for an amount other than what we have recorded in our books. Like maybe we credited our book balance by $800 when really we wrote that check for $900, right? When we look at our bank balance and see a $900 withdrawal from that check, and then we go back to our records and we see, oh, shoot, we only credited our books for $800 cash, right? Okay, so we have to subtract a little bit more because we had logged it at 800, but in reality we wrote it for 900 and we didn't know about it till we looked at the bank. So the errors committed by the book are added or subtracted on this side because the error is in this balance at the end of the month. And so after we adjust for those items, we get a post-reconciliation balance. I call this also the true balance a lot because it's the balance that is true for both the bank and the books. So whatever this balance is, the whole point of the reconciliation is we're taking two balances that are not identical, adjusting for what each of the other balances knows, and then we're coming up with a complete set of information where we should have identical amounts. On the bank side of things, what the bank doesn't know about are checks written by the company. So these are amounts that we maybe, write to our utility provider or our landlord or whatever. But these are This is cash out, checks written by the company, not deposited by the payee. It's kind of weird to say sometimes. Payee, right? What these are called are outstanding checks. So let's think about what the outstanding check is for a moment. Especially in a generation who I would imagine probably hasn't written many checks or doesn't write many checks. Um, Checks written by the company, outstanding checks. So, does the company know about these outstanding checks? It should, yes, because it was written by the company, right? The company made out a check, made it payable to, we'll say, their utility provider, right? And at that moment that they wrote that check, they can debit utility expense, credit cash. So it is in this book balance that we wrote a check. Where it might not yet appear is on the bank side of things. Because if the person to whom we wrote that check is not, has not deposited it, then the funds won't have been withdrawn from my account. So when these checks that we wrote clear, they will reduce our bank account balance and take away from it. So we subtract that. That should be a subtraction. When we have deposits we've made, so this is checks received by company and deposited, not yet cleared by bank. These are deposits in transit. So sometimes checks take, especially if it's a large check, it could take some time for it to actually land into our account. It could be a banking holiday, it could be a weekend or something, whatever it might be that it's just not in our account yet. It's not there, it's not in our bank balance. But when it does get cleared by the bank, the money's put into our account, this will add to our bank account balance. And then the final thing is if the bank might have made an error, we need to make sure we are on top of that. But if there's a bank error, then the problem is in what the bank said our balance was. It did not include this erroneous portion. And so we either have to add or subtract it depending on the nature of the error. And then this too then will finally give us our post-reconciliation balance. It's easy to try to memorize the list of things. But I have seen far too many students get derailed by a reconciliation problem. And so do not memorize it. Understand what each of these items are, why they're not included in this balance, right? Make up that story yourself. Oh, we're not keeping track of interest, the interest revenue my bank account generates. I have to wait until the end of the month when the bank adds that into my account to get the exact amount. Um, I'm taking checks from people. I don't know whose checks will be honored and not honored. Um, I have to wait for the bank to try to clear a customer check that they gave me after I deposit it. And when they tell me, oh, we couldn't get any funds from them, that's when it is. The service charges, that one's pretty straightforward. They're annoying as hell. If you have a bank account, you know what I mean. They'll just take some money out on a monthly basis for various issues. Um, and then the errors in the balance. This especially, I don't know, people seem again probably just a different familiarity with what outstanding checks and deposits of transit are for a different generation. But make sure you know more than just the definition that this means an outstanding check means the company has written it has written the check, sent it to the person they wrote it to, and that person has not yet deposited it. And then down here with the deposits in transit, yes, we received the check, we debited cash. The company has debited the cash account for the check we received. We take it to the bank, but the bank has not yet added it into our account. And then the bank errors. So that's the basic setup. This is what will get our company, this will get the reconciliation done, make sure that we balance. It's a checkpoint. It's making sure that our information is correct and the bank's information is correct. So let's apply this to the problem. There's a few problems. I suggest you work them all. They all kind of come at this in a different way, slightly different format, but all using that same idea. What does the bank know? What do the books know? So in this problem, it says that the company reports a book balance of 375, 250 at the end of January prior to reconciliation. So this is on the book side of things. The accountant for the company performs the reconciliation, adjustments where necessary, and then we have a list of items, right? If we're starting at a book balance and we are at the end of January, make sure you know where you are, beginning of the month, end of month, right? It does make a small difference, a very not a small difference, makes a very large difference in terms of where we're starting this process. So we are at the end of the period, and that's fine to just go ahead and launch into the reconciliation because we're at the end. If we were at the beginning, we might have to catch the account up to the end of the month and then do the reconciliation. So we're on the book balance of 375, 250. That's where I am. So the bank reports service fees. Now the question becomes, do I, does my book have a record of this prior to looking at the account in the bank and checking out what the activity in my account has been for the month? And they wouldn't know until the bank reports that to them. And so, yes, this is one of those things we just discussed that I do adjust for. I subtract off the service fee from the end of month book balance. uh, the bank returned an NSF customer check deposited by BG, the company, for 2,500. So this customer check, right? Um, when we received it, just to kind of give you an idea, I'm not trying to complicate it, but I want you to understand the story of how checks work, right? So when received by the company, we would have probably like someone's mailing us a check. Let's say they had an outstanding account with our company, right? We provided services, credit services, so they were an account receivable. Now they're mailing us a check for 2,500. Well, that is going to bring their account. Wrong, sorry. We're receiving a check, which is cash. So the debit's 2,500 to cash. And when we received that check, we didn't know it was going to be bad. So we went ahead and credited their account receivable because we have a check now. We think it's all good. So then we deposit it in the bank. Now, there's no entry for making the deposit because that doesn't change it. When we deposit this check in the cat into our bank, it's still in our bank account, so it would be cash. So there's no need to continue to adjust things. But when we're notified it's NSF, well, what's problematic? The problem is I debited my cash account 2,500 as if this was a good check. Well, that 2,500 then is included in this book balance because when we received the check, we debited cash and credited AR. Right? So when we were notified that it's NSF, then we have to make a reversal, right? Oh, this person still owes me money. I still have the right to receive it. And I should lower my cash balance. I didn't spend cash, right? It's just that I thought I had cash, but the check proved unreliable. So now I have to take that cash away. And we'll look again at this when we do the journal entry for the reconciliation, but this is basically what's happening and why it happens that way. So for the NSF check, we do subtract off 2,500 because that NSF check was included in this balance when we thought the check was good. Now we know it's not, we take it out. Um, the bank disclosed that BG Inc.'s account earned 685 of interest during the month. All right, so that's something that we won't be aware of until we look at the bank statement online and say, oh, look, we had $685 of interest and we should add that in now because that's what we earned during the month that we're reconciling for. So we have those four. The bank mistakenly recorded a check that BG Inc. wrote. So it's the bank's mistake. If it's the bank's mistake, it does not go on the book side because this balance is not in error. If it was a book error, yeah, we need to adjust on this side. But since it's not a book error, we can put that off for now. 32,520 outstanding checks, 28,750 deposits in transit. All right, so we have no other um no other things we need to add to the book balance. It's the three common ones, and then there was no error on the book side of things, so we don't have to worry about that. Now let's see what we got in terms of questions, because this is all I'm able to do at this point. I mean, I do have some information here about the bank side of things, but I don't know what the beginning or where to start from in terms of a bank balance. So that doesn't really help me do anything else on this side. Whereas this information flows to a post-reconciliation balance. And that is the first question here. Basically, find the true cash balance to be reported in the cash ledger. So with the true, then we just need to add these pieces together. We have 375, 250. We're subtracting 310, subtracting 2,500, and adding the 685. So I got 373, 125. And this is my true balance or post-rec balance. And so this is the answer to A. We have the true balance. Now what's B? Provide the journal entry to correct the cash balance to its true balance. So that this part is understanding kind of, well, how is this involved in our transactions and in the accounts? If we're thinking about the cash account and basically it has, well, we'll talk about everything it does have, but this really is both cash and this is our cash, not necessarily our equivalents, but just our cash. And 375, 250 is our pre-rec balance. Now, we're not at a adjusting entry place right now, but we do want to incorporate these items so that we have a post-rec balance after we've made the journal entry. So basically, we're turning this into that, and we got to do it with a journal entry. And it's really easy to see how this would affect the cash. Well, I'm subtracting 310. And so that has to go on the credit side. I'm subtracting 2,500, that goes on the credit side. And I'm adding 685, that goes on the debit side. But then what else is debited and credited besides cash? For the service fee, that's just going to be a service fee. Yeah, that's all you have to call it. Um, or bank fee, any type of fee. The important part is that it's income and it lowers net income. So basically, it's an expense. Now, the NSF check, 2,500. I kind of set that up here when I was, saying, well, what happened when we got the check but didn't know it was NSF? Well, we debited cash and perhaps credited AR. And if that's the case, hey, they still owe us money and we need to reduce our cash. So really what we have is a right to call that customer up and say, look, you didn't have any money in your account. We need that money now. So basically, we're opening up that customer's account again as a receivable because they were not able to, provide the money. So that is how we would deal with the NSF. The interest revenue debits cash and it credits interest revenue because that was earned by the company by holding their cash in the account. So that's $685. And then when I do these entries, I identify the non-cash parts of the entry, and then I just lump all of the cash effects into one uh, amount. In this case, I can use the journal entries, debits, and credits that I know that debits always have to equal credits and just make one entry to the cash account here because this is 2,810 altogether. And that means if that's 2,810, then I need another $2,125 of credit, add to 685 to get to 2,810 total credits. Of course, you could have just as easily taken, understood that, oh, okay, I lost $2,500 of cash, lost $310 of cash. That would be a credit to cash of 2,810. But then I got 685, which would reduce the reduction to cash to 2,125. Or third option, make each of these separate journal entries. Debit service fee, credit cash for 310. Debit accounts receivable, credit cash for 2,500. Debit cash, credit interest revenue for 685. Any way you want to do it, as long as you have the correct amounts debited and credited, you can break it out, you can pull it together, doesn't matter to me. Okay. But that is the journal entry we would make as a result of this reconciliation. This will bring me down to the desired post-reconciliation balance, 373, 125. All right. Part C. Determine the balance of the checking account that would have been reported by the bank per the end of month statement. So now this is asking me for, and again, understanding the process and knowing the narrative of what we're doing can help you identify what am I looking for? Because I've had people read that before, see, and they're like, what the hell are you asking me for? And I'm like, well, I'm asking you for the bank balance at the end of the month. Um, because we're using end of month balances. This is what we would get on our bank statement. We'd see where our account was. But I'm asking you to get that with just the information given, right? So not exactly going to happen in the real world, but you can figure this bank balance out with this information. And the starting point to that is understanding, ooh, if this is the book balance post reconciliation, then this also has to be the bank balance post reconciliation. So after I take the balance, which is what I'm looking for, this is part C's answer. After I find the bank balance, I will adjust it by the things I need to adjust for that the bank balance does not know to get to the post reconciliation balance. And those items we saw up here, we bypass them because they didn't belong on the book side. Let's do the easy ones first, then we'll do the error. So there were 35,000, sorry, 32,520 outstanding checks. Well, remember, these are just checks that my company has written that the bank has not yet, I'm sorry, that checks that the company has written and the person that we wrote them to has not deposited them yet. So they're still out there. When they are deposited, they will come out of our account and they will take $32,520 out when they're deposited. And then there's the deposits in transit, 28,750. So those are deposits we've made that are in our book balance, but have not yet been recorded by the bank. So these are my deposits in transit. And once they clear, they will add to our account. The error, so the bank mistakenly recorded a check that BG Inc. wrote. So BG Inc. wrote, I'm sorry, the bank recorded it for 6,700 rather than the true amount, 7,600. So basically, what happened with the error was the bank subtracted $6,700. They should have subtracted this much. So they need to take more money out of our account since it's a check that my company wrote to pay off a supplier and the bank only took $6,700 out. It should have taken 7,600. So we need to take 900 more dollars out of my bank account to hit the true balance. Basically, you can think of it this way. If the bank made the mistake, the true amount 7,600, in my book balance to get to this part, I subtracted 7,600. The bank, on the other hand, to get to its balance, only subtracted 6,700. So we have to subtract off an additional 900 for the bank error. All right, so now we have an equation that we can work with to go back into the bank balance. Right? We start at 37,125 and we're just solving for that beginning of the period balance. So we're moving everything over to this side, which means we'll add the 900. We'll subtract the 28,750 and we'll add the 32,520. And after I do all that, I get 377,795. So this is my end of the month bank balance per the bank statement. All right, so that's the reconciliation portion of this problem. This problem takes it one step further and includes a little preamble that's going to make us work before the reconciliation occurred. So these, remember, are balances that we got at the end of the month. So I'm going to transfer them over just because I want to write above them to kind of get, because we're thinking chronology top to bottom, because I want to write above these to start incorporating the information that's in part D. So this is my bank balance. And again, just write end of the month just to keep yourself on pace of where we are. Remind yourself 37, 375, 250 is the book balance. All right, so these are where we got at the end of the month of January. It says assume that our company, BG, wrote $329,000 in checks and made $450,000 of deposits in transit during the month of January. Further assume that the outstanding checks at the beginning of the month had been 28,000 and the deposits in transit had been 35,500 also at the beginning of the month. Determine the beginning of the month balance of BG Inc.'s checking account per the bank. So if this is the bank balance at the end of the month, then what we need, or what this one is asking for, is what is the beginning of the month balance of BG Inc.'s checking account per the bank. We're on this side. So it's, again, this would be our bank balance at beginning of month. So, how is the bank going to go from the beginning of the month to the end of the month balance for its customer, my company? Well, it will add and subtract the things we've done here. I'm sorry, not here. This is post-rec. The things we did here to the books. Because if we're in the month of January, at the end of January, we're going back and we're saying, oh, the bank subtracted off $310 of service fees. I need to subtract that off my book balance, right? Same thing NSF, same thing interest. These are items that happened on the bank statement about our account during the month of January. So those are all included. It would have subtracted $310 of service fees to get to what it showed me at the end of the month at the end of the month. It would have added the $685 of interest. It would have um, for the NSF check, it wouldn't have added or subtracted anything on our side, on the bank side. It would have gotten that check, tried to get it to be honored by the person who wrote its bank. And when that customer's bank said they don't have money, there would be nothing that the bank would be able to do. It wouldn't affect our account at all. Now, the other thing that can come up in a um it during the month, of course, are any deposits made by the customer, by my company, and any checks written that have cleared. So we're not talking about the outstanding checks. We're talking about the ones that my company wrote to people, those people deposited it, and they took the money out of my account for that. So you might say, oh, well, these are the $329,000 of checks they wrote. Put that here. We made $450,000 of deposit. Put that here. But there's a problem. This is this does not take into consideration, well, are those deposits still in transit? Are those checks still outstanding? Right? So, yes, the company wrote 329,000 altogether, but we have to do a little bit further analysis to get to, well, what was the actual amount of checks written? And we're going to do that by looking at where deposits in transit and checks outstanding were at the beginning of the month and compare that to where they are at the end of the month. This is a very comprehensive problem. It's probably the most comprehensive, most detailed problem, and that's why I'm trying to work through it here. Um, we'll start with the outstanding checks. So outstanding checks at the beginning of the month. So the outstanding checks at the beginning of the month were 28,000. And at the end of the month, we have these outstanding checks at 32,520. So it grew over the month from beginning to end. Now, think about what affects outstanding checks. They're checks we wrote but have not yet cleared, right? So anytime I write a check, anytime my company writes a check, before that check clears, it goes outstanding, right? Like the moment I write the check and I send it off or I put it in someone else's hand, it is now an outstanding check. So those $329,000 of checks I wrote would add to this overall balance. Now, what would reduce that balance? Because clearly, if I'm adding this to 28, there must be a reducing in order to get down to that final balance. Something must have happened to bring down those outstanding checks. And namely, those are the checks that have cleared by the bank, right? So the people we wrote them to deposited them and they've taken the funds out of my bank. And that's what we're solving for here. So 28,000 plus 329. And then we end up with 32,520. That must mean that the bank cleared 324,480. So that's what would give us the end of month amount of checks that still have not yet cleared. The 324, 480, that is what would provide the checks written and cleared, right? So basically it's, well, how many did we have at the beginning of the month? What increases this amount? Well, anytime I write a check, this amount will go up. Anytime the bank clears a check, it'll bring it down. And then this is where we settled out at the end of the month in terms of what is still outstanding that my company wrote. Do the same thing with the deposits in transit. You have a beginning amount of deposits in transit, which in this case was 35,500. Now, as my company makes additional deposits, that will overall increase the amount because until they clear, they're still in transit. So momentarily, that will boost this by 450,000 until the bank records that in our account. And then so what will reduce deposits in transit is when um, the deposit is recorded by the bank. And that's what we're looking for here. Like, what amount would the bank show was actually deposited? And when we subtract that amount off, we'll end up with our end of month amount of deposits in transit. And from our work back here, it's 28,750. And oops, sorry, I wrote that in the wrong place. That's my end of month deposits in transit. All right, so now I just do the math to solve for what was actually recorded by the bank. So we got 35,500 is my starting point. I add 450,000 that was deposited by my company. And then I'm looking for the amount that was ultimately recorded by the bank. And ooh, that's not right. Sorry, I messed up my formula here. 456,000. I don't have any room in that square anymore. So the amount I'm going to subtract is 456,750 when I solve for it using that equation. And that is the amount that I would incorporate into the story of what's happening on the bank side of things. So now I have all the pieces that would have affected my bank balance during the month. I have the bank balance at the end of the month prior to reconciliation, and I can go ahead and just work backwards again, moving all these pieces over to solve for the bank balance at the beginning of the month. And so I'll go ahead and move those over and calculate what we got. So the deposits made will add to the account, the checks cleared reduce the account. We're on the bank side of things. And so I get that the bank balance after I solve for that should be 245,150. So usually we have, some people start to lose it a little bit here. And I understand why that happens. I understand that this gets a little more involved. First, I feel like you really got to understand this part of it. What are we doing? What gets incorporated where? Don't just memorize adding service fees, NSF, and interest revenue. Understand why we have to add and subtract them from an end of month balance to get to a true balance or post-rec balance, right? We're incorporating bank information and adjusting our books by it. Over here, understand what the outstanding checks are and the deposits in transit are. These are checks, outstanding checks written by my company. And the person I wrote them to hasn't deposited them yet, so they haven't cleared my account. They haven't been deducted out of my account. These are deposits I've made as a company that have not yet been added to my account. And then the bank error itself, getting to a post-rec balance. These things happen, these things are adjustments. They'll happen in the future, right? In terms of well, for these, the money's already in the account. These things are things that will clear in the future eventually. This was added into my account already. This is something we're notified of. Now we have to collect from. This is something that was deducted from my account. Why am I adjusting for the first and the last, the service fee and the interest revenue here? It's because I'm not going to know the totals of those two things until the end of the month. I look at my bank statement and then I can include them. Then when I'm going back and asking for, well, what is the beginning of the month amount? That's when we have to kind of start really thinking it through that this was at the end of the month. Consider all of the things that would affect a customer's account at a bank, all the checks they've written that my bank has cleared, all the deposits that the customer made that we've cleared and put into their account, interest revenue, service revenue added and subtracted, right? So all of those things would have happened during the month to get me all the way back to where my balance started. Okay. So it's a pretty intense problem, but like I said, make sure that you're familiar with this piece before you start trying to really backtrack into, well, what happened during the month and worrying about the evolution of deposits in transit and outstanding checks. There is the very first problem from this example does something very similar to this. So if this part kind of mystified you, there is a problem for that. The second problem gives you a bank statement with these items in it and then has you walk forward from an end of month bank balance. So all three problems are great examples to really understand the cash and the bank rec side of the cash account.